from Asia, Europe, and the United States. This is CNBC's Worldwide Exchange.
Let's talk a little market strategy here. Emily Sanders, CEO, Sanders Financial Management, with us. Still with us for the entire hour. Charles Diebel, Head of European Rate Strategy with Nomura. Emily, I'll start with you. Just give me your take on Dow 10. Anything to you? Is it going to be part of this positive feedback loop we seem to be having, and we're going to have room to the upside? What's your take?
Brian, Dow 10,000 is a psychological barrier, and it's significant in that way, but really it doesn't mean anything otherwise. The markets are disconnected from the economy, and the economy is still sort of rumbling along, less worse than it had been in the first quarter, but really the market momentum is not driven by fundamentals. So we're still cautious about the market, the urgency of the melt up in the buying, and we're buying gingerly, but still looking for more safer bets for our clients at the moment.
Okay, so you think there's a disconnect. So part of that thesis is that the markets have come too far, too fast. You said you're cautious. And give us a little more detail into your strategy then, because, I mean, there have been people that feel a little stung by missing out, and those that waited for the pullback have really been stung even more. So give us a little more insight into specifically what you're doing and telling your clients.
Yes, absolutely. And, there is a whole risk management component of this because, there is some being left behind. But at this point, our clients are more averse to loss than, looking for the last 10 basis points of gain. Really, we're looking at things like corporate bonds, preferreds, dividend-paying multinational stocks, and also some emerging markets that are really in a growth mode as compared to the U.S., which is quite sluggish, and other developed markets. So really, we're looking at that income stream, dividends or bond coupons, or particularly preferred stocks that have stable backing to them.
Let's just bring in Emily. Charlie is here as well. I just want to bring him in on this. Emily has in the back of her mind some sort of cautious thought processes as we hear. I suppose the question is when those fears about 2010 sort of materialise into changing the way people price assets.
Yeah, I mean, I think it's absolutely right to highlight the difference between what's going on in the economy and what's going on in virtually every asset class, in that it's clearly an unsustainable situation to have government bonds doing well, equities doing well, commodities doing well, and just about everything doing well, while at the same time you have an economy that clearly is still very imbalanced. You've had this impairment on household balance sheets that hasn't been fully addressed. You have seen some pickup in the savings rate. You have seen some decline in the interest cost burden to households, but by no means getting back to long-term averages. So to sit there and suggest that the US consumer can suddenly just re-leverage, particularly when banks don't want to lend, it just doesn't make sense. So if the demand side is really dependent on that re-leveraging, that doesn't make sense, and thereby eventually that will show through. But until you get some kind of threat on the policy side, then this kind of obscure price action of everything doing well can be sustained.
And Emily, while it's sustained, I mean, how much of a pain trade is there for you? Because yes, you may well be right in your fundamental analysis, but whilst every asset class is going up, if you're not fully engaged with it, how much of a pain is there to say, well, your clients come back and say, well, hang on a sec, why aren't you engaged with, I understand why you're not, but why aren't we getting the same returns that I'm seeing, if I was just in a tracker fund?
Well, good point, Ross, about the pain. And really at this point, we're not feeling that pain, and we are pretty fully engaged. Our clients only have about, on average, 20% in cash. Now, true, that's very low earning, but if there was, a sudden drop for any reason, maybe, an external political shock, some geopolitical event, or even some craziness in Congress, which has been known to happen once in a while, we would be protected on the downside. And yes, I agree with Charlie, practically every asset class is benefiting right now. But if you look at Unemployment still rising, about 17% unemployed combined with underemployed or not even counted as unemployed, increasing foreclosures. I mean, by 2011, half of houses with mortgages are going to be in negative equity. And then, the commercial real estate is still waiting out there to burst. There's a big housing community apartment community in New York City, of $5 billion that's about to blow up. And, that might be the first leg down on commercial real estate. And there's just so many other fundamental weaknesses in the economy. Capacity utilization is still quite low, in the 60s. And so until some of that works itself out through the system, we're just really not confident chasing unless there's some, income associated with it, like a dividend or a, preferred stock yield or a muni or some kind of a, corporate bond yield. As low as they are, we've done very well with high yields, but at this point we think they're pretty toppy in high yield debt. So we're not further putting new money into that.
Okay. All right, Emily, we would love to talk to you some more. Please stay with us. Emily Sanders, CEO, Sanders Financial Management, and Charles Dable, Head of European Rate Strategy. Nomura also will continue to stay with us. Right now, let's concentrate to one of our top stories today. Dutch
Let's bring back in Emily Sanders, CEO of Sanders Financial Management. Take a look at the trading day ahead. Okay, we get Citigroup, Goldman Sachs. What do you expect, and how will it move the markets?
Well, Brian, we expect, of course, Goldman Sachs to have good earnings. They're bolstered by trading, currencies, commodities, and of course their famous compensation issues will certainly garner a lot of attention, but they have about 1/10 as many employees as Citigroup and about the same compensation. So, you take it from there. But of course, Citigroup, we're not expecting much. It's really a lottery as to whether they're going to be profitable or not. They still have assets to divest, and they still are TARP recipients. So in light of that, we would definitely stay away from Citigroup, but Goldman Sachs is the one to watch, and coming on the heels of JP Morgan yesterday, we are expecting good news, and they certainly have been able to profit from the crisis, the financial crisis in the U.S.
Do you expect overall to hold that 10,000 level today?
Well, with the futures being somewhat flat, I really think we're at an inflection point here, and even though 10,000 is a psychological barrier, we could either just plow through to the upside, based on all this liquidity and the weak dollar, which is an ongoing concern, or, flip back, to the downside, to that 15% correction that we've been expecting pretty much all summer, and has not come except for a few days here and there. So we do believe that a medium-term correction is overdue.
Yeah, a lot of people seem to think that, and it still hasn't come yet, though. Emily, we appreciate the time getting up early for us in Atlanta, Georgia. Emily Sanders, CEO, Sanders Financial Management. Quick peek at futures here before we say goodbye. We have been negative in the Dow, but only 6 points. It's been a very tight range, down a little less than 5 in the NASDAQ, and the S&P 500 about 0.1% to the downside. So it's pretty flat. We'll see those earnings from Goldman Sachs and Citigroup in just a little bit. That's it for today's show. I'm Brian Shackman here in the United States.
I'm Ross Westgate here in Europe.
And here in Asia, I'm Christine Tan. Thanks for your company here on Worldwide Exchange.